To the RBA Governor Michele Bullock. She's speaking on the recent decision to keep interest rates on hold today.
But because monetary policy operates with a lag, we need to think carefully about where we're going. With inflation coming down and employment growing, we think we remain on the narrow path. The board's been trying to bring inflation back to target in a reasonable time frame while preserving the gains in the labour market. But underlying inflation currently remains too high, and for some time now we've pointed out there are risks on both sides. Because persistent inflation is so bad for the economy, we've been alert to the upside risks on inflation, but we've also been conscious of the downside risks. Recent economic data have been mixed, and some indicate a softening in line with our forecasts. That said, on balance, some data are a little softer than expected. This has given the board some confidence that inflationary pressures are declining, but risks remain. The board judges that monetary policy remains restrictive and is working as anticipated. We discussed today that perhaps some of those upside risks to inflation appear to have eased, but they haven't gone away. The board still assesses that the level of aggregate demand is above the economy's supply capacity, even though that gap is closing. The board will be looking to the data over the next month or so to see if the economy and inflation continue to evolve as expected. The board needs to be confident that inflation is moving sustainably towards the target, and for this to occur, we need to see more progress on underlying inflation coming down. Today, the board discussed where we think the economy is going in 2025, what's next, and how to keep inflation coming down and employment growing. We discussed whether there's something we might be missing or misunderstanding and the risks to our forecasts on both sides. What might we see in the coming months? Could unemployment start to climb sharply? We're not anticipating that, but it's something we need to be alert to. How will consumption respond now that real disposable incomes are starting to rise again? And how will that impact underlying inflation? Could we see a smaller than expected outcome for underlying inflation in the December quarter, or might we get a surprise in the other direction? None of these things by themselves would necessarily lead us to the conclusion we need to change monetary policy settings, but they may tell us something about the level of demand and supply in the economy and where inflation and employment might be headed and how we might need to respond. The truth is that some inflation pressures remain and cost of living pressures remain a burden on all Australians. It's also important to note that prices are not going back to where they were before this high inflation. The high inflation over the past couple of years has permanently increased the price level. In fact, prices in September quarter 24 were 16% higher than they were 3 years earlier. That's the extent of the inflation. And that's hurt everyone, but particularly those on lower incomes and the more vulnerable. We haven't had a sustained period of high inflation in Australia for more than 30 years. It's not familiar to people, but it's one of the key reasons why people are doing it tough and finding it harder to make ends meet. The RBA's job, our mandate, is to keep inflation between 2 and 3% and to aim at the midpoint, 2.5%. And we use the cash rate, which influences interest rates that households and businesses face, to achieve this by curbing the growth of demand across the economy. That's because inflation is the result of demand for goods and services being higher than the ability of the economy to supply those goods and services. And we want to bring inflation down in a way that doesn't cause a spike in unemployment. That's the balancing act we are trying to get right, and it is a challenge.